here's a case study. We got someone making $6,500 a month, net take home. Expenses are $4,550. We have a total debt of $9,000. Not a whole lot of debt. They're not a homeowner. And we have a cash flow of about $1,950. So some of the numbers that I gather before I even put an infinite banking strategy in place, okay, this is a client that is in the process of putting a policy in place, right? So some of the numbers that I pull from them is I take their cash flow and I times it by 12 to understand how much free cash flow do we have available to fund this particular strategy, right? So cash flow times 12, $1,950, right? Times 12 is $23,400, right? Then what I do is I take their cash flow in a year and I times it by 2/3. This is the same formulas that I use for velocity banking to help determine how we're going to make a chunk payment to eliminate debt. I use the same method in terms of how we're going to fund a life insurance contract. So if they're cash flowing $23,400 a year on average, using conservative numbers, and 2/3 of that is $15,444, right? Then I'm educating the client. I'm saying, look, if we try to fund a policy at $23,400, that would be extremely aggressive, right? You understand that you're taking 100% of your cash flow and you're putting it into one basket. Doesn't really make full sense to me, right? So I express that to them. So then I say, well, if I took 2/3 of my annual cash flow per year, $15,444, and I say, this gives me a baseline, right? This gives me a foundation that this is a number I know I can do because I cash flow significantly more than $15,444 in a year. Then the other number that I'm grabbing, right, is I'm also finding out with the client how much are they saving per month per year. So part of this $4,550, they are automatically saving $500 a month, okay? So we actually included of the expense, $4,550, their cost of living. In there, we've included that every time they get a paycheck, they automate $250 per paycheck, so that's $500 a month. That's just automating going into a high yield savings account. So 500 times 12 is 6,000 a year. So there are three numbers that I gather when I'm talking to a client, one of you guys watching my YouTube channel, a follower, anyone that comes into my ecosystem. When we get on a phone call together, there's three numbers I'm trying to figure out before we implement the infinite banking strategy, infinite banking concept, right? Which is, what is the low number, right? What's the number I know I can do no matter what, with my eyes closed, this will get funded. So when we look at, okay, a very low number would be whatever you're saving per month, because it's something you're already doing. So I'm implying that in this case study here, and assuming for you that we already have a discipline of saving money. I would say in order for any infinite banking strategy to work to its full extent, I believe personally you need to have the discipline of already saving money on a consistent basis. And that money is going into a separate account, savings account. There's some automation involved. I believe if you already have that discipline, you are on your way to successfully implementing one of these strategies. So in this case, our low number would be $6,000, right? Because they're already doing it. It's already accounted for in their expenses. And then their goal number could be 2/3 of their annual cash flow per year, right? So sometimes I'll even underestimate and just round down to say, okay, our goal number is 15,000. And then because of how we can design and structure a whole life insurance policy, we can design it in a way that we can grow with the policy, which leads to my third number being the max number. What is the max dollar amount that I want to be able to pay into this policy in any given year for the funding duration, right? So when I'm talking to the client, and again, this comes with getting to know you more. This is a type of person with a military background, high discipline, very motivated, They have a desire to increase their income. They have a desire to succeed. They have a desire to build a business. So knowing those details about this person and about you watching right now, I can then propose, hey, today your average cash flow in a year is $23,400, but I'm pretty sure you and I can make a strong argument that this income is going to increase, right? We're dealing with a person in their mid 30s, right? Like 35, 36 years old, right? So we're still young, healthy, motivated in our producing prime years. Their income's going to go up. So then I can say, well, we can design a policy where we can max fund up to $23,000 a year. So meaning my required low number, right? My low number would be the requirement. No matter what happens, I get $6,000 a year into my policy. My goal is to save $15,000 a year, right? So we're increasing the savings number to implement this particular strategy, $15,000 a year. And then we're saying, hey, max, I should at some point, even now, be able to max fund up to $23,000 a year into this policy, right? So as you're watching, you want to get these three numbers locked in for yourself. Denzel, here's my low number. This is what I know I can do. This is my goal. And then this is my max number. If you design a policy that way, you are accounting for ups and downs. You're accounting for the fact that, hey, there might be a down year. There might be a death in the family. There might be a tragedy that occurs. There might be a car accident. There might be a storm that happens and totally drains my cash flow. So if it totally drains my cash flow, right? Well, I know I can at least get the $6,000 in, right? And what's cool about a whole life insurance policy is you can always make up for lost time, right? You can always do what's called a make-up contribution. The next year, you fund $15,000 and then you make up for the say the $9,000 that you didn't put in, right? You put in $6,000, right? There was $9,000 left of space to hit your goal number. You can get that in the next year, so you can make up. That's what's really cool. So you don't lose on your ability to fund the policy. So low number, goal number, max number. Then you've got design and system. Okay, these are two intricate pieces for success before implementing the strategy. So what is the design? Okay, design is referring to literally these three numbers. Like, how is your policy being structured? How is it accounting for ups and downs in your life, right? Now, to sort of summarize the space of infinite banking as it relates to design, is you will typically see, as it relates to where your money goes once it's in the whole life insurance contract, your money goes into two places: premium and cash value, right? That's like your two general locations where money goes. Premium is just cost of insurance. Cash value is cash value, money that shows up day one that's going to be growing. Your premium is what's covering your death benefit, protecting your human life value, creating generational wealth, right? So the design of it can be anywhere, typically, again, summarizing this entire space of infinite banking, all the different terms that it gets, all the different YouTube channels and TikTok channels that exist that educate people. You will typically fall within the range of 1090 to 4060, meaning 10% of your money, say $15,000, 10% of it, $1,500 is going to base premium, or as high as 40% of your money is going to base premium. So 15,000 times 40%, say $6,000, so anywhere from $1,500 to $6,000, right? How you design a policy is going to have a direct impact to whatever strategy you choose. So if you're trying to use one of the strategies here on the board that would require a higher amount of cash value upfront in the first years, that you're going to borrow from it initially, then you're probably not going to want to go with a high base premium because you're going to have less cash value available upfront, right?